last time's discussion, and we discussed about the ratio analysis, and under the ratio analysis we discussed about liquidity, profitability and solvency of a particular organization. And we went through the different ratios where we can discuss about the liquidity, profitability and solvency in that particular organization. And we practically, we have gone through practically on these things, and how we can give the particular analysis by looking at the ratios and indicators. Now, when we did that, those analyses go on several organizations, but those are not really banking organizations. But banking organizations, if you do the performance evaluation of a banking organization, it has a specific way. So now today we are going to discuss about such performance evaluation methodologies where we can apply for the banking organizations. And basically today our discussion will focus on RORAC and RAROC. Now, if you go by the letters, so you can say RORAC is return on risk-adjusted capital. That is RORAC. The other one is RAROC, that is risk-adjusted return on capital. Now, it looks like similar, but it's not similar, but two different concepts. RORAC, return on risk-adjusted capital. Now, here the capital is adjusted, and capital is adjusted on risk. And there we measure the return on that adjusted capital. Risk-adjusted capital. Now, we measure the return on risk-adjusted capital. And but there the adjustment is made on the capital in terms of risk. Then the next one, that is RAROC, that is risk-adjusted return on capital. Here, now in the second one, we are not going to adjust the capital, whereas we adjust the return. So we adjusted the return in terms of risk. So in other words, we do the adjustment with regard to risk in the return. I think when we go through the particular calculations, you will realize the difference. Now, if you go into a traditional bank performance analysis, it has three fundamental issues. Now, when you go into compare or just do some performance analysis, basically the analyst, they ignore the strategies, the wide diversity in strategies, because different institutions follow diversified or very diverse type of strategies in their day-to-day business. So the performance evaluation or performance comparisons would not be possible in that way. So therefore, this is the most prominent flow in that such type of a performance analysis, where in that analysis, the analyst don't take into consideration, do not take into consideration the wide diversity in strategies, because each organization has their own strategy. So that is the situation. So the second issue is, now if you go by the total assets as a criteria of measurement, it won't give a real yardstick or real measure. It is not meaningful because many banks now engage in off-balance sheet activities in a substantial way. So therefore, it is not that easy to go by the total assets and get an idea about the organization. Since the banks deal with off-balance sheet activities or transactions. So therefore, it is not a yardstick to measure the performance through the total assets. Because off-balance sheet items are so many. And it is now the banks, there's a tendency of the banks to engage with these activities in a very substantial manner rather than those days. Nowadays, if you go by quantitative terms, you will find that the total of contingencies and commitments sometimes goes very high into about, say, 50% of the total assets sometimes. So that's a scenario where an analyst may not be in a position to get an idea through the total assets of the bank. Then the third flow would be the analyst provides no direct information concerning how each of the bank's activities contribute to the creation of shareholder value. Now, the shareholder value creation is a task where the organization has a unique approach. So that unique approach, the analysis or the analyst may not get an idea about that. So they won't get any direct information towards such type of activities. So that is the third issue when you go into the performance analysis of a bank. Now there's a small chart here. I don't know, you can get a better view on that. I will try to zoom it. Yes. Now just look at this chart. Now the heading of that chart is performance gap. Branch customers have high expectations but indicate a variety of service problems. Now you can just see there are different preferences. Knowledgeable personnel. Now when customers come and try to get the services of the bank, they have several preferences because they look at the services through these features. Now, knowledgeable personnel should be there. So that is, I think that is the highest level of the majority of people looking for, 83%. Knowledgeable personnel. Then enough tellers in busy times. Automated teller machines. Concierge assistants. Personal computers. Now these are the types of expectations of customers. The problems are teller lines too long, hours not convenient, tellers too slow, inconvenient locations, resolving problems is a hassle, takes too long to open accounts. So these are now there can be a list of this. Now, through a survey, this information being collected. So now you can see the differences of expectations of customers, and in order to provide customer-centric services, the banks will have to look at these expectations also. So in that sense, the banks will have a difference of approaches. No, what I want to tell you is now you can realize the reality of this. In reality, what is happening. So that is why we all can predict or hypothesize. There would be a wide diversity in strategies pursued by different institutions. But there's a thing called uniform bank performance ratios. Those were introduced. And after introduction of these UBPRs, most banks did similar things, which were reflected in their balance sheet. Now, if you look at these list of things where we can consider as similar, that they accepted deposits and made loans, and many interest rates were regulated. So that's a commonality in all banks. And then you have this pursue sharply different strategies. I think it is very clear now. You all got an idea why the banks pursue sharply different strategies, because their requirements are different. The customer expectations are different. The economic environment is different for each of the banks, and their strategies are different. So that is how the strategy, the variety of strategies come into the scene. Now we will see the different performance indicators and their validity on these organizations. Now, if you take into consideration ROA, that is return on assets, it can be considered as a biased indicator of performance. But return on equity is a more valid one in terms of equity holders. Now, when you talk in terms of the equity capital of a bank, so that really deals with all the activities, because that equity is a very principal item in the balance sheet, and whatever the activity going on, the capital has a bearing on that. So therefore, either the activity is on balance sheet or off balance sheet, the equity would play a major role on that. So therefore, if you take ROE as an indicator, that could be more valid than getting ROA as an indicator. So ROA, because that really go into asset size. So asset size would not give a correct indication about the bank. So therefore, ROA may not be a valid indicator. Whereas if you compare with ROE, that would be a more valid indicator. Thus, a comparison of net income to equity captures the returns to owners' contributions. So, I think the principle behind this is return on equity would give an idea about the returns. In terms of the owner's contributions. So, in other words, if an owner contributes something, out of that contribution, the quantity of returns the person would get. So, such idea is given through the ROE. But if you go into a set of banks, set of peer banks, and if all these banks have similar type of strategic focus, and if they offer similar products and services, then the asset size and uniform bank performance ratios would give meaningful comparisons. So I think it's a very simple concept. You can't really compare different type of things, because if you want to compare something, it should be similar. Otherwise, you can't compare, because comparison can be, you can compare apples with apples. You can't compare apples with oranges. It's like that. So that's a very, very simple type of a concept. So that concept comes here also. Now, in order to identify the peer institutions, or appropriate peer institutions, or a set of similar organizations into the analysis, the management should consider the following type of features. What is the bank's strategic focus? So that's a very important point to note. As an analyst, if you go into a comparison of peer banks, so then you need to see what is the bank's strategic focus. Then what are the traditional balance sheet and off-balance sheet characteristics of firms with this focus? Now, those are traditional type of things where it has been there for a long time, and traditional balance sheet and off-balance sheet characteristics of firms with this focus. So you just select, or you just identify the main strategic focus of the bank, and then see what are the balance sheet and off-balance sheet characteristics of this type of organizations. How do the bank's activities affect its operating revenue? Yeah. So the bank's activities, how it affects the operating revenue. So that's another factor you need to look at. Right. I think as a starting point, what you need to do is you need to identify the bank as either a loan-driven bank or a deposit-driven bank. So this common trend or whatever. So that is a very important point to note. As a starting point, you need to determine whether the bank, your subject bank, is more loan-driven or more deposit-driven. I think there are several characteristics which you can identify to put the bank into the appropriate category. There are two categories in that sense. You have the loan-driven bank and you have the deposit-driven bank. Now we will see what are the main characteristics of a loan-driven bank. loan-driven banks' profitability is generally a function of net interest income, or in what we call interest margin, with loan volume a major factor. So I think you can just look at it like this. If the bank is a loan-driven bank, the profitability is generally a function of net interest margin. And another factor is a loan volume. So then you can just check such type of a bank, and you can tabulate even if you want to tabulate it. So in the table, you can have the loan-driven bank in one side, the other side you have the deposit-driven bank. In the loan-driven bank, the profitability is a function of net interest margin. When the net interest margin goes up, profitability goes up. And there's another factor, that is the loan volume. If the loan volume, the bank can increase in time to come. So that is another factor in the enhancement of profitability. So such characteristics are very much visible in loan-driven banks. If you go into deposit-driven bank, their profitability is generally a function of non-interest income, with franchise value and deposit volume a major factor. Now, there the deposit volume or the market share would be a major factor for a deposit-driven bank. But their profitability may not depend on interest margin. But their profitability depends on non-interest income, because they get the customers. They are not going to specialize in loans, but they provide different types of other services, and those services are fee-based. Then their income, the large component of their income is non-interest income. Again, a loan-driven bank. Now the asset size basically determined by the loan demand. And the profitability is determined by cost of funds, loan yields, and such type of things. Those are the economic type of things on loans. Profitability is determined by loan yields, cost of funds, and other economic type of activities. Now, for a bank which we can categorize as a loan-driven bank, their loan margin is very high, and they have a high non-interest expenses. Because they have to pay different types of fees to maintain their loan-driven position. And I think this is a very important point to note, and it's very, very interesting to have this type of concept. Our bank underwrites loans better than other banks. Now they just tend to say that their loan management or credit management or credit risk management is very much better than other banks. That is their culture. They have a handful of credit experts in their boards or in their corporate management level. That is, they normally just say that, or they are very much proud about their underwriting abilities. Now here it says value is typically some multiple of core earnings. So So value is very high than the core earnings. That is what it means. But if you go rather into a deposit-driven bank, their asset size is determined through the growth of deposits. And the value is determined by the franchise value measured by the market share of low-cost core deposits. Because if you go into a bank's deposit base and do an analysis, a simple analysis on the structure or the profile of their deposit base. And for a deposit-driven bank, you can find a high contribution of low-cost deposits in the deposit mix. So in that case, you can see current accounts and savings accounts more than 50%, basically. But they have a lower interest income and lower interest margins, non-interest expenses. Then they are laden with lower loan losses. Not that much of loan losses because they are not going to give so much of loans. Their main focus is on deposit mobilization, not the granting of loans. Right. Then if you go into the investors' intentions, especially the investors in bank stocks, their concern is whether the bank's management is creating value for stockholders, creating value. Now, this creation of value may not be the profitability, but creation of value is you have to create economic value and all that. So that really comes with the employment generations, then asset value and all sort of things. So therefore, this is a very broad type of a concept. When analysts compare performance over some historical period, they are less concerned with ROE and ROA and efficiency ratios. Rather, the overall total return from investing in the bank stock. Now, if you take in terms of the stock, the overall return is the more important thing. So they are not very concerned about the efficiency ratios. The total return equals dividends received plus stock price appreciation. Now, this is in terms of a stockholder, a shareholder. Their concern is to have dividends. Not only the dividends, the value appreciation of the stock. So these are the two things and a stockholder expect from a bank. So then stock price appreciation or depreciation. So this is the most important thing for a stockholder. Therefore, now the return to stockholders, you can see the change in price. Now here the particular code is given, a symbol is given as the change. This is what you call delta. Delta price is the change in price plus dividends divided by price at T minus 1 means at the year beginning of year price. This is end of the year. The change in price plus dividends divided by at the beginning price or stock price at the beginning of the year. I think this is simple. Then earnings per share. Change in net income after taxes and dividends on preferred stock divided by number of shares of common stock outstanding. So we call it earnings per share. So in other words, after tax profit, you should take and divide by number of shares. Then price to earnings, there's a ratio. It is not a percentage, but it is, we give it in times, like PE ratio we call it. So it is calculated by dividing stock price with EPS. EPS, the earnings per share. Then price to book value. Stock price divided by book value per share. Now this will give an indication about the appreciation of market value of a stock. Because if you have value more than one, that means the stock price has gone up against the book value. Then market value of equity is market value of assets minus market value of liabilities, or number of share of common stock divided by stock price. Sorry, share of common stock into stock price. That is what you call market value. So for example, if you have 100,000 shares, now each share is 100 rupees valued. So 100,000 into 100 is 10 million. 10 million worth. So if the share value goes up to 110, so your value would be 11 million. So market value of assets, market value of equity is that 11 million in that case. Right, now the example is given here. Buy 100 shares of PNC Financial at the beginning of 2001 for $73.06. The bank paid 1.92 per share in dividends that generated reinvestment income of 9 cents. Yes, now you can see the price has gone down from 73.06 to 56.2. So that's a minus value. So you have a dividend declaration of 1.92. Then the return to stockholders comes to minus 20.3. So we can just see how it has been calculated. 56.2 minus 73.06 plus yes. Dividends been given 1.92 and they have a reinvestment income of 9 cents here. So 1.92 plus 0.9 comes here, 2.01. So it is to be divided by 73.06 and you get a value of minus 20.3. Right. There can be, in a bank, there can be a hybrid situation where the bank might work as a normal retail bank, and at the same time it is operated as an investment bank. So that can happen. So I think there can be real-time examples also for such type of banks. Traditional law customer bank activities include most loans, core deposits, payment services, credit enhancements, asset management, and financial advisory. Now, these are the examples for services in a customer bank, traditional. For investment bank, there will be investment portfolio, non-core deposits, purchase liabilities, loan participations, asset sales, bank-sponsored mutual funds. Now, these are the different types of business activities done by an investment bank. Items are assigned based on whether the underlying activities pertain to bank customers or the bank itself. Can evaluate the returns on each bank relative to the risk. Beyond benchmarks. Now we can go into another very popular type of activity where the banks been measured or evaluated through performance, and that performance evaluation is based on their business lines. And in other words, we call it the business line wise profitability. So each business line, there will be a measurement device to look at the profitability of that particular business line. Not only the profitability, you have to measure the liquidity, then solvency and such type of things also in different business lines. Now, the way it is being done is by allocating operating expenses to activities that support bank customers and bank management. Banks can obtain at least a rough estimate of segment net income. So you can categorize the transactions into different segments, and for those transactions you can have a different profit and loss account and get in the net income calculated. Now, for specific type of customers, we have to gather data. They are non-financial performance data and financial data, and that will enable the bank to identify certain types of business lines. Now you can just look at the different ways in which a bank can categorize these businesses, how they are going to categorize. Type of loan customer, small business, middle market, consumer installment also. Type of depositor by characteristics of the relationship, account longevity, cross-sell patterns and profitability. Delivery system, branch, ATM, telephone, home banking, etc. Now these are the ways in which a bank can categorize different businesses or business lines. Now I think there's a very good example now we can give a thing called digital banking. So they are the delivery system. Through the internet or ATM or whatever, you deliver your services. So that is digital banking we now call. So such type of business lines can be identified. Right now we have come to the focused topic RAROC and RORAC. RAROC refers to risk-adjusted return on capital, while RORAC refers to return on risk-adjusted capital. Now just see the underlying requirement here. In order to analyze profitability and risk precisely, each line of business must have its own balance sheet and income statement. And that's what I told at the beginning. When you want to measure performance business line wise, then you need to have separate P&L and or even income statement and a balance sheet for each business line. In that case, you need to identify all the transactions as it is, and transactions has to be categorized under business line. Now, there are different types of issues which can crop up when you try to do this type of categorization. Now, these statements are difficult to construct because many non-traditional activities such as trust and mortgage servicing do not explicitly require any direct equity support. So equity support is not necessary for this type of things, and then it is very difficult for us to categorize it under a certain business line. And even traditional activities such as commercial lending and consumer banking complicate the issue because these business units do not have equal amounts of assets and liabilities generated by customers. So that's another issue, because there are several loans or whatever which cannot be put into one line, or even one loan has 2 or 3 types of characteristics, and then for that reason it can be categorized under 2 or 3 business lines. So that is the issue when you go into this type of business line wise performance analysis. So critical thing is to just assign the equity to each business line. So this is the most important thing here, assigning equity capital to each unit. Now these are the capital allocation methods. Using regulatory risk-based capital standards, assignment based on the size of assets. So you can go by different types of principles, where one way you can go by the amount of assets in the business line, or you can have risk-based capital standards to just assign capital. So for example, say if you have 100 million worth of assets in the business line, you can allocate 10 million worth of capital there, because the regulatory requirement is 10% of risk-weighted assets you should furnish for capital. So such type of principle we can apply. Or benchmarking each unit to pure play peers that are standalone, publicly held firms, and measures of each line of business's riskiness. So another way of doing it is go along the riskiness of different business line. Now say if a business line is seems to be more risky than the other business line, the more risky business would have more capital. So that is the requirement. Right, now we can categorically go through that. Though it is used interchangeably, the meanings are different. Risk-adjusted return on capital, RA, ROCE. So there, which comes to the numerator is risk-adjusted income, divided by allocated capital That is the denominator. So this method, the income is adjusted for risk. Typically, income is adjusted for expected losses. So the risk means in the definition, risk is normally defined as the potential loss. Potential means the expected loss. Then when you go to the other indicator, there is return on risk adjusted capital. And it is given as RORAC, and it is return on. So return means net income divided by allocated risk capital. Allocated risk capital. Here the adjustment is made on the capital. Capital is adjusted for risk. Typically, capital is adjusted for a maximum potential loss based on the probability of future returns or volatility of earnings. So there's a very clear way of doing it. Potential loss based on the probability of future returns or volatility of earnings. Because you all know that in the future, you can say that there can be different future returns can be different. There can be several deviations or several types of changes in the future return. So therefore, that is what you call the volatility of earnings. So that can happen. So that the capital can be adjusted by looking at the risk. So that is what you call the risk adjusted capital or allocated risk capital. Right now, we can go through an example here. PNC reported results for 7 distinct lines of business. Now, here it is attempted to just give some idea through 7 distinct lines of business. Now, regional community banking, that is business number 1. Then you have corporate banking. Now here, these 4 types of business lines being taken as banking businesses, and the other 3 being taken as asset management and processing. Now, just look at the first number 1. It is regional community banking. It is just banking. Then you have a corporate banking arm. Then real estate finance also been taken as banking. Then credit, business credit. That is also coming under banking, and this is also taken as a different or separate business line. Then you have asset management and processing business. You have advisory arm, PNC Advisors. PNC is the organization's name. BlackRock is another organization, and they do asset management or processing on BlackRock. Then PFPC is also another institution. The data were obtained from PNC's management accounting system based on internal assumptions about revenue and expenses allocations. And assignment of equity to each line of business. Now we can have a look on the profitability analysis for 2000 to 2001. Now, just look at the heading here. Shall we zoom it? Just look at it. Financial results for PNC by line of business. Now, you can see the columns here, earnings. This column is earnings, and it gives the earnings of on 2000 and 2001. Then you have revenue. That is also for 2000 and 2001. Return on assigned capital, average assets. These things are considered as financial results for the year ended December 31st. And it is given in $1 million. Now they just talk on banking business. Under the banking business, you have regional community banking. There you have in 2000 there's an earning of $590, $90 million, whereas 2001 it has gone up to 596. And corporate banking, there's a earnings net earnings of $241 million, whereas in 2001 there's a big loss, $375 million loss. And PNC real estate, they had a profit of 84 million in the year 2000, and in 2001 it is 38 only. And 49 in the business credit, they have a profit of 49, but in the 2001 they have only profit of 22. So overall, if you take overall banking as a total, you get 964 in 2000, and it has come down to 281 in the 2001. Now this is a drastic reduction in profits or earnings, basically, in the banking business. So that's a very dangerous, or to say, substantial type of a decline. But when you go into revenue, there's an increase in revenue in the regional community banking business line, and corporate banking also there's a reduction in revenue, but it is not so sharp as the reduction in profit. Real estate finance also, you have a decline in revenue, but the decline is a marginal decline, whereas the decline in earnings is very drastic. Now even the revenue for business credit is increased from 190 to 134. Earnings, there's a decline trend in the earnings. It has declined from 49 to 22, whereas the revenue increased from 190 to 134. Earnings declined from 49 to 22. So that's a peculiar type of situation, and we have to have more inquiries on that. When you look at the return on assigned capital, now you see, even though the profitability has gone little up, the return on assigned capital is taken as same. In corporate banking, it has come down from 18% to 30 minus. Here 21 to 10 and 32 to 30. So this can be taken as it is because there's no peculiarity here. But the peculiarity comes with business credit line, where you have a revenue increase of say about 15 million increase in the revenue, but there's a decline in earnings by 27. Yeah. And average assets also, you can see there's not much of a difference, but you can see, yeah, if you take the total lines, the difference is not that visible, but it's a very marginal type of a decline. And if you go into asset management and processing lines where you have VNC advisors, they are also, the profitability has come down. Yes. Even BlackRock also has come down. So the meaning is overall there's a decline. Now total business results also, it shows drastic declines in the income or the earnings. If you take the total business, the asset size has a marginal increase. But if you say other income or whatever, all are negative. Results from continuing operations also very drastic reduction of earnings. Then revenue also. The revenue reduction is not that high, whereas, yeah, it's a marginal reduction, but you can see the reduction in income has gone from 1279 to 382. Now, if you go into the two lines of business for PNC, corporate banking represents products and services provided nationally in the areas of credit, equipment leasing, treasury management, and capital markets products to large and mid-sized corporations and government entities. Now, this is what you call corporate banking. And community banking encompasses the bank's traditional deposit branch-based brokerages, electronic banking and credit products to retail customers, along with products to small businesses, such that it is primarily a deposit generating unit. Then you have corporate banking, asset. So descriptive income statement and average balance sheet is given for the corporate banking. And regional community banking also you have a income statement and a balance sheet. Right. Now, all these figures are given for clear understanding about these things. Then we go into risk-adjusted income and economic income. Right, now you can just see how this adjustment to the income is made. Two adjustments are frequently made to income in line of business profitability analysis. The return is adjusted for risk by subtracting expected losses. Now that is the main adjustment, the deduction of expected losses. The return nets out required returns expected by stockholders. Required returns expected by stakeholders also to be taken out from that. Cost of equity. Yeah. There's a concern whether RAROC is greater than the firm's cost of capital, cost of equity. Then you have to allocate risk capital. In the next calculation, the objective of RAROC analysis now, the objective of RAROC analysis is to assist in risk management and the evaluation of line of business performance. As part of this, it is necessary to assign capital to each line of business. Now, here some of the criteria to allocate capital is given. Banks allocate risk capital by regulated risk-based capital standards. Or you can go by asset size and benchmarking versus pure play standalone businesses or perceived riskiness of the business unit. Now, when you say perceived, now I think there can be different vague type of scenario can crop up. Where perception, if you go by the perception, that's not a scientific way, but anyway, in order to allocate capital in a certain way, so if you don't have any other ways, you need to go by the perceived riskiness of the business unit to have a allocation of capital. Unfortunately, most lines of business do not have market value balance sheets. In the balance sheets, the values are not being marked to market. Hence, many banks focus on the volatility in economic earnings or estimate a value at risk figure. So, what they do is they just go by the economic earnings or earnings at risk volatility. Economic earnings, volatility in economic earnings means earnings at risk. Now, this can be given in a statistical form, the volatility of earnings from a line of business. Now, what do you mean by volatility? In statistical terms, we call it the standard deviation. Securities underwriting and letters of credit against customer exposures at the large bank do not require much capital to support day-to-day operations. Yes, now these things are basically self-securitized. But before a bank can actively engage in this business, it must have a strong credit and bond rating, which requires a substantial amount of risk capital. Yes, now these particular things, the underwriting and letters of credit, the capital requirement is comparatively low for these things. That is what it means here. Basically, letter of credit is not a on-balance sheet item, and there's a conversion factor in order to calculate the capital charge for letter of credit. So that depends on the nature of the letter of credit. If it is a bid level letter of credit or standby letter of credit or whatever, then it can become a bid type thing where it goes around 20% of the letter of credit is taken as a credit equivalent. So that is why here it mentions securities underwriting and letters of credit against customer exposures at a large bank do not require much capital. So that is what it means. But before a bank can actively engage in this business, it must have a strong credit and bond rating. So in order to engage with letters of credit and underwriting of securities, they should have a very strong capital base. So therefore, they need to have a substantial amount of risk capital in that. Yes. Required risk capital is related to the volatility of earnings. Now there's a small exercise here. Using historical data for each of the past 30 months, estimate revenues obtained directly from these loans. Using historical data for each of the past 30 months, estimate direct expenses from offering these services and expected losses. Using the 60 observations for revenues minus expenses and losses, estimate one standard deviation of earnings. That is what you call the earnings at risk. Estimate risk capital as 1 for 2 standard deviation of earnings divided by the risk-free interest rate. Now we will go through this and see what is it all about. Allocating risk capital based on earnings volatility. Now here a methodology is given in order to allocate risk capital, and that is based on earnings volatility. Now in the securities underwriting and latest of trade division. Now the monthly revenue or net revenue is given here in most recent 30 months observations. And you can, I think in order to put it in a simple way, the mean and the standard deviation is given. Mean is given as 5.06 million and standard deviation is given as 0.735 million. Then allocated risk capital is calculated on the basis of, now they assume a risk-free rate of 5.5% annual. Now go by monthly. Now just look at this calculation, and I want to just explain the way in which the risk capital is calculated. Now that capital calculation is made by looking at the standard deviation of revenue or profit or whatever. Earnings, what you call earnings, right? Standard deviation of earnings. Now you just look at the equation. The risk-free rate into risk capital is equal to standard deviation or earnings at risk. Now the risk capital is calculated as 160.364 million. So that is allocated risk capital. So for the most recent month, RORAC, that is risk return on risk adjusted capital is 6.4 divided by 160.364 on monthly basis. Right. Anyway, now I want to just show you these things as important type of calculations. Here our concern goes to the calculation of return on risk adjusted capital and calculating the economic income. I will just explain these things on the board. Right. Right. Now we will go to the calculation of RORAC, that is return on risk adjusted capital. Now I have given a simple equation there. Now you can see risk-free rate of return or risk-free rate into risk capital is equal to earnings at risk. Earnings at risk. Earnings at risk is the volatility of profits or volatility of earnings that is taken as the standard deviation or sigma. Now as it is, you all now got the figures here. Now what we are now trying to do is we try to get the value of risk capital with other data. Now here the available data is, so I will show you. Right. Now in this case, in this particular organization, the securities underwriting and debtors of credit division, their monthly livelihood expenses, that is the monthly net income, is given. In the first month it is 4.3 million, second month 4.5 million. Likewise, they have given 30 months results. This is the net income in millions. And not only that, they have given the mean value of those earnings. It comes to $5.06 million. Standard deviation is also given as 0.735 million. Now, in order to allocate or in order to arrive at the risk capital, what we are now going to do, we can put these values into the equation and we can calculate the risk capital by substituting the values there. So you note down the values here. The values are, you can see the mean value as 5.06 million. Mean is 5.06. Then you have standard deviation is 0.735. Yes. And you need to assume the risk-free rate as 5.5%. That is the annual rate. Here we got the standard deviation in monthly revenue, monthly net revenue. So therefore, this annual risk-free rate has to be converted to the monthly risk-free rate. Okay, I will explain this. Now, what we are going to do now is, we have this value, risk-free rate, we have the earnings at risk, and we put into the equation and we can solve risk capital, or we can get the value of risk capital. Right, I will do that. Now, risk-free rate is given as 5.5% annually. 5.5% annually. So this can be represented as 0.055 in the decimal form, right? So when you give it as the monthly risk-free rate, this particular quantity has to be divided by 12. So 0.055 divided by 12 into risk-free rate equal to earnings at risk. Earnings at risk is the standard deviation that is given as 0.735. Now, by this we are now calculating risk-free rate equal to 0.735 divided by 0.055 by 12. So this is equivalent to, I will do the calculation somewhere here, 0.735 into 12 divided by 0.055. So if you do the calculation, you get the answer here. You get the value as sum as 60.364. This is the risk capital. This is the risk capital. So now we are going to calculate the return on risk adjusted capital. But I think you are okay with the calculation, is it? Are you okay with the calculations? Now we have calculated the risk capital. Risk capital comes to 160.364. 160.364. Now our next step is to calculate the risk-adjusted return. Return on risk-adjusted capital. So here the return is given. So what is the return?
Sir, excuse me.
Yeah.
Sir, in the equation, I think it's not clear because so when you were substituting in the board behind you, it's 0.055 divided by 12 into risk-free rate, or is it a risk-free capital? You have written it as a risk-free rate.
Risk-free rate.
Right?
Sorry. You are referring to this one?
Yes.
That is risk capital.
Capital.
That is risk capital. That is risk capital. Yes. Sorry. Risk capital. Right, now what we need to do is, now we have already calculated the risk capital. Now what we need to do is, we need to get the return on risk adjusted capital. So then we have got the capital and we have to get the return. Return is also given. That is 5.06. Mean return is given as 5.06. So now just can you calculate return on risk adjusted capital? Yes. Right. First of all, you calculate the return on risk adjusted capital, the mean value of the in the sense you can get the mean return. Now mean return is already given, no, 5.06, no. So therefore, on that basis, you calculate return on risk adjusted capital. So how are you going to calculate? So get the answer. Now I think you have arrived at the risk capital as 160.364. And first calculation you need to make for the mean return, taking into consideration the mean return, and calculate the return on risk adjusted capital. Simple thing. I want to get your engagement. That is why I just ask you to do it. Now what I am asking is to calculate based on the mean return, monthly return, to get the return on risk adjusted capital. Because we got the risk adjusted capital and we got the return also. So then it is a matter of dividing the return by risk adjusted capital into 100. That will give you the return on risk adjusted capital. So get the answer. Yes, you try it and do it, because this is important. Otherwise, you will become very drowsy at just listening to my harsh voice. Yes, can you put into the chat the answer? Yes. Yes. Yes, Nuani's answer is correct. Correct. 3.16 is the monthly return on risk adjusted capital. And if it is annualized, it is 37.86. Now here I want to give you a small hint, because either you can follow when you have the monthly rate as 3.16. So we normally do, we multiply it by 12 and get the annual rate. But then if it is to be annualized, what we need to do is we need to get the 12th power of this and minus 1. That would be that would give the annualized rate. That is the most accurate one, but I don't know. This is also okay, no issue for the time being. But I want to just mention about it, because in financial calculations, what we do is, if you have a monthly rate of 3.16 annual, the annual effective rate would be 1 plus 3.16 divided by so much to the power 12. Then when you want to get the real annual rate, that is minus 1. So I will show you how to do it. Now 3.16 is, we can put it as 0.0316, and you have to plus 1, and you have to get the 12th power of that. Then you get 1.4525 something, then minus 1. That would be 45.25. So that is the answer. But for the time being, I would say that the calculation of effective rate would be, now here it is okay. You just, what you just did was you multiply it by 12, is it? So we will see whether in the slides show what they have done. Yeah. Anyway, we can, for the time being, what we can do is we can just go by multiply it with 12. That's okay. That would be okay. So your answer is correct. But when you do it, I mean, in the effective way, that would be 45.26. That is okay. But I think here this is acceptable. 37.86 is acceptable. But what I want to say is now in a scenario where you get this thing, if you want to calculate this, then you have to mention that effectively this is the rate. 45.26 is the rate. That is the effective rate. But if you just say that when it is monthly, it is so much, you can say it is 37.86 by multiplying with 12. So that's okay. Now I will ask you to do something else. I will again go into the presentation. Right. Now you do the calculation. I think it is done here. But anyway, say you do the calculation for the most recent month. Most recent month. Right? You follow me? Just do the calculation for the most recent month. What is the calculation you need to do? You need to do the return on risk adjusted capital for the most recent month. It is given here. It is given here. Okay. So if you do that, then you have to put 6.4 as the numerator, and it is to be divided by 160.364. Right. Now I want to just give you another trial here.
Sir, excuse me, sir.
Yeah.
Sir, how did that 3.16 come? I didn't get that answer.
3.16. 3.16 we got through this. Now as it is 5.06 was the mean. No? Then what we did was we divide 5.06 by 160.364. You just do it and see. Now you get 5.06 as the mean net income, is right? 5.06. It is the mean. No, it is given 5.06 divided by risk capital. Risk capital we calculated as 160.364. 160.364. It comes as 3.155. So that is how we got 3.16, because if you go into two decimals, you get 16. Is that okay?
Okay, sir, I got it.
Right.
Thank you.
So then now you do this. Now say you now when we calculate the risk capital, we have taken the earnings at risk as the volatility of the earnings, or one standard deviation of earnings, right? Sometimes we can assume the earnings at risk as two standard deviations. Two standard deviations. You got my point? Now, when we did that calculation at the beginning, we assumed the earnings at risk as one standard deviation of earnings. That is why we took 0.735 as the value there. But there can be, or there are instances, the earnings at risk can be taken as two standard deviations, not one standard deviation. Because if you want to go with value at risk or whatever, so you go by that way. So you need to go for two standard deviations. If you go for two standard deviations, then your risk capital will be different. So calculate the risk capital for risk capital assuming the earnings at risk as two standard deviations. Can you do that? This is a simple task, but you need to do that. Instead of 1 sigma, you need to take it as 2 sigma. Yes. Anyway, now have you done the calculation? Now, when I ask you to do the assuming the earnings at risk as two standard deviations. Earnings at risk as two standard deviations. So then what happens is you calculated the earlier one with 0.735 as the standard deviation of earnings at risk. So in this case, if you go by two standard deviation, then it should be 0.735 into 2. So then you get a value twice the value of earlier one at the risk capital. Anyway, Noni has asked a question, the hurdle rate. Now we go into the hurdle rate next, right? Hurdle rate is the cost of capital. Cost of capital is the hurdle rate. Now I will just explain that also. Hurdle rate is really the cost of capital, or we call it cost of capital. Or the hurdle rate, there's another explanation on hurdle rate. Sometimes we call it required rate of return. Required rate of return. I'm just answering the question given by Nuani. No, we call it not the capital charge, we call it the required rate of return or cost of capital. Cost of capital. So that is the way it can be explained. Hurdle rate is that. Cost of capital or required rate of return. But for an organization to be, say, going concern, at least the return on capital has to be, return on risk capital, adjusted capital should be higher than the hurdle rate. It should be higher than the hurdle rate. Is that okay, Nuani? The hurdle rate is that. Right. Now then we will see how we are going to calculate the economic income. Now the economic income means what? Risk adjusted return. That is economic income. Now you can see the hurdle rate is 12%. And if you get the required rate of return, you have the capital, risk capital, and multiply it with the hurdle rate. Now, hurdle rate is given as annual 12%, which means it is monthly 1%. So 160.36 for 1%, 6.4 minus that, you get 4.796. That is the economic income. Or the capital charge. Even the capital charge is given as risk capital into hurdle rate. I think you can keep these equations in writing. You can write it down if you want. Hurdle rate is equal to, you can say, hurdle rate is equal to required rate of return. Required rate of return. Or cost of capital. Now, what we are now trying to do is, we try to see the economic income calculated. So, we have to deduct the capital charge from the net income. Net income is 6.4 minus capital charge is calculated by multiplying the risk capital with the hurdle rate. So you get 6.4 minus 1% into 160.364. That is 1.6. 6.4 minus 1.6 comes to 4.796. So that is the answer, and we call it economic income. We call it economic income. Now, when you go into measurements, rather than the net income, economic income will give you a better understanding or better explanation. Now, shall we go into the next next slide? here the balance sheet is given. Risk-weighted assets. Now you have 800 million worth of securities, 2000 million worth of commercial loans, 1900 million worth of credit card loans, 250 million worth of assets, and there's a loss reserve, but that loss reserve doesn't have any risk weight because it's not an asset. So risk-weighted assets comes to 4,550. And Tier 1 capital, 320, because it is equity. Total capital, 320. Yeah. Now you can just see here you get the minus value as loss reserves. So those loss reserves can go as Tier 2 capital. So that is how that comes to 420. So total capital ratio, Tier 1 ratio would be 320 divided by 4,550, that is 7.03. And total capital ratio is 410 divided by 4550. Here the interest, income and expenses are given. It is self-explanatory. Right, there are several other explanations here. Yeah. Okay. Now I will just give you a small exercise here. Based on these figures, you need to consider the same monthly revenue less expenses figures, and the standard deviation is also the same. But I am trying to change the risk-free rate and the earnings at risk calculation base, and the hurdle rate also, by new values of risk-free rate, risk-free rate, and the new earnings at risk value. You need to calculate, and the new hurdle rate. You need to calculate the RORAC and the economic income. Most recent economic income of the company or the bank, right? I will put it on the board. Now you can see, assuming the risk-free rate as 8% and the hurdle rate as 15% and the earnings at risk as 1.5 sigma. 1.5 sigma. Calculate RORAC, that is return on risk adjusted capital, and the economic income for the most recent month. And you assume all other figures remain unchanged. I will keep it for you, and you can just take down the details here, and at the same time I will put the other slide also. Then you can go through that also if you want.
Sir, can you again read what is on the board, sir?
Yeah. Assuming the risk-free rate as 8% and the hurdle rate as 15% and the earnings at risk as 1.5 sigma. 1.5 sigma, not 1 sigma or 2 sigma, 1.5 sigma. That is 1.5 standard deviations. Okay. Now, Nuani has asked question, should we use 2 standard deviation or 1 standard? Not the 2 or 1, you have to use 1.5 standard deviations. Okay, Nuani, 1.5 standard deviations, right? So, assume all other figures remain unchanged, right? So, shall I put the slide on the screen? Or you have the figures with you? You have the figures with you, or? Right. I think you can make this note on your book and I will put the slide on. Any questions on this? Now, in the meantime, I will put the, yeah. Now here, all other figures you can apply except what I have given on the board. You can do the calculations, and in the meantime, you can have a break also. I will come back by 4:45, right? Have you tried to do it? I think you should be able to get on the risk capital. Because our standard deviation is 0.735, and when you get the earnings at risk as 1.5 sigma, so you have to multiply 0.735 with 1.5. And to be divided by the risk-free rate has become 8%. So if you put it into a 1 month rate, then it should be 8% divided by 12. So what you need to do is, you need to get 0.735 into 1.5 into 12 divided by 0.08. Yes, Nuani, I will just put the things on the board, and I don't know whether Nuani has taken the mean net income or most recent one. Yeah, most recent one. Right, now what I want to do is I will just explain the things on the board. Since we, at the new situation, we get the risk-free rate as 8% and hurdle rate as 15%. Now, when you say risk-free rate is 8%, in a monthly basis, it is 8% divided by 12. So we can put it this way: the calculation can be taken, and the other side is 0.735. That is the standard deviation, and we can take it as 1.5 sigma. That is 0.735 into 1.5. So that comes to, this is the earnings at risk, 0.735 into 1.5. That comes to 1.1025. That is the earnings at risk, 1.1025. So that has to be divided by the risk-free rate. So 1.1025 divided by 0.8% divided by 12. So that comes to 1.1025 into 0.08. Sorry. Risk capital you got as 165.375. Yeah, correct. Then we got we will get the RA, ROC, ROR is return on risk capital. Return would be for 6.4, no? 6.4. Yeah. 6.4 divided by 165.375. Yeah, that comes to 3.87. 3.87, and 3.87 is the monthly return on risk adjusted capital, and it has to be annualized. When you annualize by so Nuani's answer is correct. 57.71. That is the effective annual rate. Effective annual rate of return on risk adjusted capital is 57.77%. That is effective annual rate. Then we will go to the economic income. Economic income is the net income minus capital cost. Capital cost is the risk capital into hurdle rate. So there you get 6.4 minus 165.375 into hurdle rate is new hurdle rate is 15%. That is the annual. So therefore, the monthly rate would be to be divided by 12. 4.33. Yeah. That 4.33, it is not the economic income. Yeah, right, correct. 4.33 is the economic income, correct. Right. I think others also followed it, no? Is that okay? Right. Now, if you go into the physical nature of these things, the most important thing is, yeah.
So excuse me, I didn't get that answer. Can you explain a little bit?
It is like this. Now, first of all, we calculated the return on risk-adjusted capital, and there we first calculated the risk capital. Risk capital is calculated by dividing the earnings at risk by the risk-free rate. Earnings at risk is 0.735, that is the standard deviation, into 1.5. Because I just gave that point, no, I said you have to get the earnings at risk at 1.5 sigma. The meaning is you have to get the earnings at risk at 1.5 sigma, means 1.5 standard deviation. So therefore the standard deviation is 0.735 and it has to be multiplied with 1.5. So that comes to a value of 0.735 into 1.5. That is 1.1025. So in order to get the risk capital, you have to divide that value by risk-free rate. Risk-free rate is 8% as it is, and we have to get the monthly rate, and 8% divided by 12. So therefore, that comes to 1.1025 into 12 divided by 0.08. Right? So that will give the value of 165.375. That is the risk capital. That is the risk capital. So in order to get the return on risk-adjusted capital, you have to get the return divided by risk capital. Return is 6.4. Most recent return is 6.4. That has to be divided by 165.375. That comes to a value of 3 point something. And if you want to get the annual effective rate, you have to add 1 there, and that has to be raised to the power of 12 and minus 1. You will get the effective annual rate. So effective annual rate comes as 57.7. Right? So that is one part of it. Then we need to calculate the economic income. Economic income is calculated by deducting from the net income the hurdle rate into risk capital. Hurdle rate here given is 15%, and it has to be taken as the monthly one. So 15% divided by 12 into the risk capital, that is 165.375. So when you do the calculation, you will arrive at 4.33. That is the economic income. I think that that gives you the correct insight. Is that? So you can just check and see whether the answer should come.
I got that 165 should be what could 183 something.
Oh no, we got it this way. I will give the numbers again. Nah? So first of all, we calculated the earnings at risk, right? So that is now standard deviation is 0.735. No? So 0.735 into 1.5. That comes 1.1025. You got that figure? 1.1025?
Yes, sir.
So that has to be divided by the monthly risk-free rate. Right? What is the monthly risk-free rate? Risk-free rate is 8%, is it? 8%. 8% we can put as 0.08.
Yes, sir.
And it has to be divided by 12, no? because you have to get the monthly rate, no? So then when you do the calculation, it looks like 1.1025 into 12 divided by 0.08.
Okay, sir, I got it now.
Right. If you do that calculation, you will get 165.375.
Okay, sir. Okay.
Right. 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 Now we will go to the slide. Right. Now I just want to give you some physical applications here. Now say, in order to have a risk capital, now you have seen, if you go to higher levels of standard deviation, say we started with 1 standard deviation. We just assumed 1 standard deviation as the earnings at risk. And later on we assumed 2 standard deviation as the earnings at risk. Of course, when you want to have a high level of economic capital, or what we call is, if we can provide capital for unexpected risk also, you need to enhance the number of standard deviations. Now, in other words, you will have a high confidence level when you raise the level of standard deviations. For example, if you have a 2 standard deviations at the level, your confidence will go up to 98, 96, 97%. And if you have about 3 standard deviation, like, you will get 99.9 type of a confidence level. So what does that mean? You are 99.9 sure that your risk capital would not go beyond that level. So when you raise your standard deviation levels, what would happen is your risk capital also would go up. So that is the physical meaning of this calculation. So therefore, if someone wants to have a more realistic risk management in a particular organization, you need to have a higher earnings at risk. So that higher earnings at risk will enable you to have a high level of capital, and that capital you will become more comfortable, and you might be able to have a very high level of risk appetite with high risk capital. So I think you got my point, because and the hurdle rates and all sort of things are being calculated, and then you will be in a position to have a economic income, but that economic income may not be higher than as you when you had it when you took the earnings at risk as only 1 standard deviation. But that particular thing would be there, but you would be more comfortable in a risky scenario. That is the important thing you need to look at. So that is why this risk-adjusted return or risk-adjusted capital is very much important for a return calculation, especially for a bank. And this hurdle rate is another important point to note. Hurdle rate is none other than the required rate of return or cost of capital. Required rate of return or cost of capital. Then the next slide is the balance sheet. There you get all the details, and you got the risk-weighted assets calculated and the different risk weights you can notice here. Now this 800 million is securities, and the risk weight of that is 50%. That is why we multiply it with 0.5. And the 2000 is commercial loan that has a risk weight of 100% since those are loan. And even 1900 is another credit card loan that is also multiplied with 1, that is 100%. And another 250 other assets that is also multiplied with 1. And you have a loss reserve that goes to the other side, because since it is a reserve, it goes as a equity. So therefore, even it can be taken as tier 2 capital. Now you just look at here, the tier 1 capital is 320 as given here. And total capital is given as 420. That comes with 100 loss reserves. 100 loss reserves as taken as tier 2 capital. And capital ratio has been calculated by dividing the tier 1 capital with total risk-weighted assets, that is 4,550. And tier 1 capital is 320, and 320 divided by 4,550 comes as 7.03. Then total capital ratio, total capital is 420. So 320 is the tier 1 capital, 100 is the tier 2 capital, and altogether it is 420. 420 divided by 4550, that is 9.23, that is the total capital ratio. Now when you go into the statement, income statement, and we try to...
So excuse me, sir.
Yeah.
Why, sir, equity is minus? Yeah.
Pardon? Equity. No, equity is minus because, now when you put the things in that perspective, wait. Now when you say liabilities and equity, now it is given as minus because now equity is also a liability. That is why we put it as a minus. But if you really get the total here, they have taken just the total. They have not considered minus. You just, add up and see. 320 also added here. Right? 320 also added here. Just look at and see when you add it up, you get 5,000, no? But if you add 320 or if you deduct 320, you would not get this value. Right? Because 800 plus 1008 is 26. 26 plus 13 is 39. 39 plus 100 is 4. 4 plus 320 is 4320. 4320 plus 680 is 5,000. It comes as it is. Now, the minus is given. It is given as a sign, and equity, though equity is worth, it is considered as a liability. That is why they have put it as minus. But that is why liabilities, equity is categorized as liability. In order to give that indication only, they put the minus here. Now you can see here also, when you say other assets, that is also given as minus. Other assets. Loss reserves also given as minus. Now loss reserve is a debit. Other assets is also a debit. But those are, now when you say loss reserve, this can be taken as a reserve. This can be taken as a reserve. That is why it has gone to the tier 2. This 100 has gone to the tier 2. But this 250 been taken as an asset. Now, you got it clear? Or?
Yes, sir. In the asset side, when you added up, that goes 5,200, no?
Asset side, 2,400. Yeah. Now here what happens is when you say loss reserve, now they put it as minus because, now when you put it, now loan loss reserves to be deducted from the loans, no? That is why they put it as minus 100 here. Okay. Now when you say other assets, those are debit balances. Those are debit balances. That is why they have put this as minus. But you see, 2,200. Yeah, 5,200 is the value here. See. Yeah, you get altogether 5,200 here, no? When you add it up, that comes to 5,200. Then but it is very clear that this loss reserve is being taken as the equity, though it is in the asset side, right? Though it is in the asset side, it has been shown as a deduction, right? This is being taken as a deduction. So then only 5,100 is here, but if that is the case, but equity is added here. Now, when you say deferred tax credits, now though it is given as 100 here, now I think this is the issue. Now these two things form to 200. Now that 200 difference has come with this deferred tax credits and this one. That is the issue, I think. Anyway, it looks like something wrong in the adding this thing, but the rationale behind this minus indication is, now when you say loss reserve, that can be taken as a deduction from the total assets. I mean, from loans. Now say when you have a loan value of 1,000 and provisions value of 200, then we put it as the net loan value would be 1,000 minus 200. So that is the way it is to be here, given here. So I think that is the issue here. But this 250 can be, even though it is taken as minus, that minus comes with now that is a depiction of debits. That is why they put it that way. So that means even though they put it as assets, it is not really assets. Those are book debits. That is the meaning here. Anyway, I will see whether there's anything, any more things, and I will let you know later if it is a case. But it seems like that is the issue, because everywhere when you have a reserve, that reserve is just taken, deducted from the total amount. That is how it comes. And the risk-weighted assets taken as this way. Now our interest income, say.
Sir,
Yeah.
excuse me, sir.
Yeah.
That in the earlier sum we may make that in the economic income we calculated that risk capital should be multiplied by the
hurdle rate.
But when only that we have to multiply, then that I'm not getting that answer.
No, hurdle rate actually, we had the hurdle rate as 15%, no?
Yes.
So that has to be divided by 12.
Okay.
So then it is to be multiplied with the risk capital, that is 165.375. Then it is to be deducted from 6.4.
It should deduct that amount, 6.4 deducted.
Yeah. No, from 6.4 you need to deduct that particular calculated amount. So that comes to 165.375 into hurdle rate. No, hurdle rate is 0.15 divided by 12, right? So that comes to something, and when you deduct that amount from 6.4, you will get 4.33. You can just do that.
4.3, no? 4.33 should be the answer.
Yeah, that is the answer.
Okay, sir. Okay, thank you.
It seems that there's a arithmetical error here. Anyway, but what you need to get from here is the basics of risk-weighted asset calculation and the capital adequacy calculation. That is what you need to get from here. The other thing is the income statement, where you get the interest income. So interest income is from the assets you get the interest income. 800 into here 6.5 is the rate, 0.065 into 2000 into 0.09, and 1009 into 0.10, and that comes to $422 million. And interest expenses comes as the other side. You get demand deposit, you don't charge any interest. MMDAs, that is some other types of assets, and it is 1800 and into 1800 into 0.03. Then you have 1300 CDs, 0.055, and small time deposit 680. So then you get interest expenses as minus 156.1, and you get the net interest income as 265.9. Then provision for loan losses, non-interest income, non-interest expenses. Then you come to pre-tax income as 110.9. Net income is 66.54. Then you do the profit measures. Return on equity, capital is 320 and 66.54 divided by 320, that comes to 20.8. Return on assets, 66.54 divided by 5,000, that is 1.33. Now here you have another one here, economic value added. Now you see 550 as the risk capital. 550 and allocated capital charge is charge of 12%. So then economic value added is 74.9 is the profit. Net operating profit after tax, 74.9, and we now here the hurdle rate is given as 12%, and you multiply it with 0.12 into the capital charge is 550 risk capital. So you get the EV as 8.9. Now this is the change in balance sheet items. Now credit card loans, it are deducted by 1,000 and loan loss reserves 30, then you get 970. And liabilities also divided, decreased by 970. So this is only a adjustment. Now these calculations can be done through any type of balance sheet and income statement. Now you can just check the income statements here. So the core things which we have learned here, and we can get the risk-adjusted return on capital and the return on risk-adjusted capital. Those are the two things which we have learned in this discussion. So I think we need to make use of these principles in our question papers. And last time we discussed on a question, and we have not been able to complete that. Anyway, we can just go again to that particular question paper and see whether now I don't know whether you have done it at home, the other type of ratios being calculated, because we do a performance analysis by looking at ratios, and those ratios are being categorized under liquidity, then the profitability and the solvency, and with that we need to calculate all these ratios. So I think my memory, I think we did up to liquidity and profitability calculations. Is that so? Or have you done at home?
Sir, excuse me, sir.
Yeah.
I have a small question that in the previous sum, how that risk capital 550 came?
One? 550.
Risk capital 500.
Yeah, I will show you. Now we have to get the risk-free rate here. But this 550 is a it has not been taken as a calculated amount. Now here you can see the tier 1 calculated, tier 1 ratio calculated, total capital ratio calculated, but they have not calculated any. Here the total capital is 420. No, it is 420. Then this risk capital, it's a assigned capital, allocated risk capital. This is allocated risk capital. Now that allocation being made with some assumptions. That is the reason. So as it is, now you can remember how we have calculated the risk capital at the earlier instance, where we have gone through the earnings, net earnings volatility, the standard deviation of net earnings. So in the same manner, they calculated the risk capital here. So that is, you get the earnings at risk divided by the risk-free rate. That is how the risk capital is calculated. And they have not mentioned about how they have done the earnings at risk calculated here. So that should be the way, here the profit is taken as, you can see the profit. The profit is taken as 74.9, right? Profit is taken as 74.9, but no traces of volatility of the profits. It has not been mentioned here, but this 550 is an assumption. They have taken 550 as the risk capital. That's how it can be explained. So this is the value where if you have a volatility of this value, so then we need to have several years profit income statements to do that. Because if you have about 30 to 50 values of this nature, you would be in a position to calculate the volatility of that. So that without that volatility, we are not in a position to calculate the 550. So the risk capital can be calculated only with that. So if you have earnings at risk, and then it is to be divided by risk-free rate. So then you will be in a position to calculate the risk capital. But here the risk capital is assumed as 550. It is not a calculated figure. Nowhere it has been mentioned about how they have calculated the 550, but that 550 comes with that. Now I will show you the way it happens. That's a very good question, and now you look at the statement here, the balance sheet. There you have only equity as 320, and as it is, they mentioned the total capital as 420. But in the same question, there's an assumption that they took the risk capital as 550. So if they take risk capital as 550, is it rational to have a 550 like risk capital here? Because they are, while their capital is only 420. So in reality, you cannot take that way, no? So that is why I am telling. Now, as a bank with some insights, they thought that we need to have a risk capital of this amount in order to face with the risk. So therefore, they are in the next year, their main concern is to enhance the capital level up to 550. So that is their intention. That is why they took 550 as the risk capital. I think you got my point, because this 550 is not a given value here. Sorry, it's a given value here. It's not a calculated value. You got my point?
Yes, sir.
Because I think in other way I can explain this in this way. Now as it is on the balance sheet, you have a capital of only 420. That you agree, no? So in that sense, we are not in a position to have a capital of 550 here, but it's an assumption like. So we call it economic capital because you have only 420 as capital. But for the next level or next year's activities, you assume that you will have a risk capital of 550. So that assumption comes with the more risk appetite. So in order to have a more risk appetite, they go with earnings at risk, which is higher than 1 standard deviation. So it can be either 1.5 or 2 standard deviations. In that case, they will have to have a higher risk capital. That is why they put 550 here. It is an assumed type of a figure, not a calculated one. Right.
Sir, the thing is in that PAT, that means profit after tax.
Yeah.
That 74.9, how that has come?
Yeah, it is. This is 110.90 is this one. Pre-tax income is 110.9, right? Here. Then 25 added. 25. That is, 25. That is the provisions. Provisions been added. Now they want to get the operational income, no? Net operational profit after tax. Net operational profit. So this is not the income deduction, no? Provision. This is a loan loss provision that has to be added, no? That is why that is been added here. 25. Okay.
Okay.
25 is a provision. That provision is not. It's a non fund based thing. It's a provision. So that provision has to be added here. That's a provision only. Pardon?
Other two, sir.
22 is a charge off. Net charge off, we call it. Charge off. Charge off means written off type of a thing. That is 22. Then cash taxes. Taxes paid. Cash taxes paid. 39. So that is how it comes. These are operational things. Now this 22 is also a charge off. Charge off means you have written down some loans. Write off. It's a write off. And this is also a cash tax paid. This 25 being added because it's a provision. Provision being added. Like, when you have depreciation or whatever, that has to be added also. That is the way it has been added here. Is that okay?
22 and 39 is not mentioned anywhere, right?
No, here it's mentioned. Assuming that net charge of 22. You can see the
okay, sir. Okay.
The upper line, assuming that net charge offs 22, cash taxes paid 39. So these are those two items being deducted here.
Okay, sir. Okay.
Then you get 74.9, right? Then you get the economic value added by deducting this amount, that is the risk capital into hurdle rate. Hurdle rate is 0.12. This is on annual basis, right? They put 74.9 as the NOPAT, that is the net operating profit after tax. So that is 74.9 minus 0.12 into 550. So that comes as 8.9. So that is the economic value added, or economic value, economic income or whatever. So this is a rather good explanation. So with the figures, if you take it in that way, I think that's a good understanding. You get a good understanding here. And of course, this is a type of a realistic valuation, because we normally go by the income statements and just look at the profitability only without looking at the risk or whatever. So this is a realistic valuation of a balance sheet and profit and loss account, where you get all these things factored in. Now that is why we go by the, not only with ROE and ROA, we go by RA, ROC, that is return, risk-adjusted return on capital, and the return on risk-adjusted capital. Both ways we do. So that gives you a good understanding about how the economic value added is taken into the organization. Now, the last slide shows you the changes happened in the balance sheet and how those changes been instrumental in enhancing the profitability. Now just see the differences here. ROE is, early ROE is so much, 20.8, whereas here it comes to, yeah, it has come down, 19.47. And ROA also, ROA has been increased from 1.33 to 1.40. But ROE has come down from 20.8 to 19.47. Economic value added has, it has been drastically reduced to minus 15.9, no value addition. So these things are also very much important for a realistic analysis. Okay. Right. Actually, last time we discussed about the question where we went through the performance ratios pertaining to liquidity, profitability, and solvency. I think we did some ratios on liquidity, even profitability. Anyway, we can go back to the question paper. Now this is about Excellent Limited. Now, I think we have gone through these things to a certain extent last time. And I just ask you to just work it out during the week. Don't know whether you did it. Anyway, if you don't need any explanation on this, it's okay. Then otherwise, I can just explain it again by going through the different ratios. Of course, the necessity is to, I mean, the calculation is one thing, but you have to be very clear about the analysis. Analysis is very much important than the calculations, because the figures as it is will not give any type of support for decisions, but that support for decisions would come only with the analysis. Now this is the income statement also has a comparative thing from 2015 to 2016. Cost of sales increased. Gross profit also increased. Other income increased. Selling and administrative expenses also increased. Operating profit increased. So likewise, I think the company looks like having a good performance. Profit before tax also increased. And earnings per share also increased from 6.87 to 8.82. Now, basically, you need to have a superficial look at the statements and have a superficial type of analysis. Then later on, you need to go deep into that and do the ratio level analysis. And of course, here what you can do is only a comparison. Trend analysis is not necessary or not possible here because you have only 2 years. Only a comparison, just a comparison. So you can't do much on with this one, but if you have another 2 or 3 balance sheets and statements, then you can analyze the trend even. Now, if I get the presentation also into the screen, so we will see. You can get the other things into the screen. Now here we are going to have a horizontal analysis, however, ratio analysis. Now, I think in these lines, you need to do the question that we have discussed: liquidity, profitability, and solvency. We did these things last time. Receivables turnover and all that. Then we need to go to the profitability ratios. Right. Now, shall we do this? I think, if I remember correct, we haven't done this, no? Profit margin calculations last time with the question. Net income divided by net sales. Right. Now you have profit for the year, that is the net income. You can even get profit before tax. So I think this is the one, yes, profit after tax. 110,446 divided by 39,267 something. No, that comes to the net income divided by sales. For the both sides you can do. Then you come to the then you have net sales divided by average assets. So average assets, of course, now here, since you have only 2 years here, so you can just get the net sales of 1 year and then divide it by the same amount, same year's amount. So then you get asset turnover ratio. And net income divided by average assets. Return on assets, that is return on assets. Then you should get net income minus preferred dividends divided by average common stockholders equity. So that is return on equity. And earnings per share, net income divided by common shares outstanding. So here the number of shares. So you can just see whether this particular question paper or question gives the relevant details. Now you can just see the equity. Stated capital is given, capital reserves and revenue reserves. Right. Now all these things you can do by looking at the ratios and the figures. You are asking a question. Only asking a question about hurdle rate and the capital adequacy ratio. Actually, the thing is, capital adequacy ratio doesn't give a indication on that. But what we can do is, it is the cost of capital we need to get in order to get the capital adequacy ratio calculated. It's like this. Now, hurdle rate, actually it is the required rate of return. Required rate of return. The meaning is this. Have you heard about a term called weighted average cost of capital? Weighted average cost of capital. So that is what you call the hurdle rate. Weighted average cost of capital. WACC. WACC. That is weighted average cost of capital. So that is what you call the hurdle rate. Or sometimes the banks come at prime rates also. Sometimes they take the prime rate as the hurdle rate. So of course that all depends on the ALCO's decision. But in general, if you put it in a general perspective, what you do is you just try to get the cost of capital calculated. Cost. Because the cost comes with several things where if you do say ICUs, and sometimes you get debt capital or whatever. So all these things will put into the weighted average capital, cost of capital. So therefore, but in some cases you have a tax benefit. If you have debts or whatever, you have a tax benefit, and that tax benefit really reduce your cost of capital. So that is how the cost of capital is calculated, and the cost of capital is taken as the hurdle rate, not the capital adequacy ratio. No, you can't take the CAR, because the CAR is a different. That has different implications. Now that is adequacy. So you need to have adequate level of capital in that way. So that doesn't have a direct connection with the hurdle rate. The hurdle rate is the rate where a bank has to, generate a return which is higher than the hurdle rate. Otherwise, the bank doesn't have an economic value addition. That is the real explanation for that. I think you got my point, Nuani? Yeah. When calculate economic income also, now say economic income is calculated by getting the net income minus the cost of capital. So there you get the hurdle rate into risk capital. Hurdle rate into risk capital. As you say now, CAR doesn't have that type of relationship. Because I just want to tell you, CAR has a different explanation. Now, CAR looks at the bank's risk capital, or we can say the level of risk, and the CAR is recommended as an absorbent of risk. Absorbent. It doesn't have any, what you say. It doesn't mean the cost. The capital cost is a different type of concept. That is why we can't say that CAR has a relevance with the hurdle rate. The hurdle rate has its own origins, because not only for a bank, any organization, the capital is a very costly item where it's very difficult for them to collect. For example, if you in terms of a bank, if there's a share issue, I think they have to incur high expenses to raise capital. So that really adds to the capital cost. So therefore, now say if you have so much of capital cost, then your hurdle rate goes very high. So what is the result of that? When the cost of capital goes high, the hurdle rate goes high. That means your cost of capital will be very high, and if you have earnings, net earnings with you, and when you deduct net earnings, when you deduct cost of capital from your net earnings, there can be a minus value. So in that case, your cost of capital would be very much higher than your net earnings. Then you are not going to grow economically. There won't be any economic value addition. So that's the issue. But the capital adequacy ratio doesn't have any relations with that. Now, on the other hand, say if an organization is in a position to generate capital internally, then their cost is very low for that capital. So that is the retained earnings. When you have a high profit, you would be in a position to, after even declaring dividends, you would be in a position to just retain higher amount. So that will enable the organization to have a high capital growth. And at the same time, the organization will be able to control or minimize the cost of capital, because no capital issues and no expenses for such capital issues. So that is why then the hurdle rate will become lower. When the hurdle rate become lower, the bank or the organization will be in a position to have an economic value addition, because even with a lower level of net income, the bank would be in a position to have a earning rate higher than the hurdle rate, or earnings higher than the capital cost, and that could enable them to have economic value addition. Right. I think that's a good explanation, and that's a good question also. You all should have that type of arguments and say that type of ideas. And it really gives the other people also a good understanding and good insights into the lesson. Right. Now, I think this particular question, you need to try on your own, and you try to do these ratios calculated. And for the time being, I will go into another topic where you need to have some understanding, solvency test or whatever. Because we talk on solvency, in the organizations, but this solvency test is more applicable for non-banking organizations, basically, because the banking organizations will have several other ways of measuring the solvency or getting some idea about the solvency. But this solvency test is really applicable for non-banking and other type of manufacturing type of organizations. I will show you the particular details.
Sir, in the question there, since excuse me, sir.
Yeah.
In the question there, that in previous question, number of shares are not given, so we can't calculate that.
That's the thing. That's the thing. Yeah, I have done that. Yes. Anyway, now of course the particular question didn't give any type of an indication what type of ratios to be calculated, but you need to select the relevant profitability ratios. So if you don't get the information to calculate certain ratio, so then you can omit that. So what you can do is that, because there's no hard and fast rule to say that this particular ratio should calculate or whatever. No? So then therefore you have to go by the available information. If information is not available to calculate that earnings per share or whatever, and it is given, no, earnings per share is given, I think, but some other things we may not be in a position to do if the information is not available. But you can go for another type of a similar ratio where the information is available. Right. And I think you need to tabulate all these things. Then with the tabulation, it is very much easy for you to do the analysis. And you would get more marks if you put it in a, say, structured way, or in a particular feasible way. That's what, no, I can tell you that way. I mean, it is like this. You need to have a table. In the table, you say liquidity ratios. Then you put the ratios. Then you say 2015 so much, 2016 so much. Then you go for the solvency ratios, or sorry, profitability ratios. There you get 2015 so much, 2016 so much. Then you get solvency ratios. There also you can put that way. Then you can put a small comment in front of those ratios. Small comment. Then you have an overall comment in, you can write a paragraph or 2 paragraphs on that. So paragraph each for each characteristic, or liquidity 1 paragraph, then profitability 1 paragraph, and solvency another paragraph. That way you can do with the tabular form, and it will give you a certain way of presentation, and that will influence, or that will really give a good influence to the examiner. An examiner will satisfy himself and give you good marks. So that is what you need to do. And say, sometimes you might come across something, as you say, the information is not available. So then just omit it. Then you need to have a similar type of a ratio to calculate. So that is how you need to just tackle that type of issues. Okay. I think I really need to give you some idea about solvency test. Now it's a simple thing on the face of it, but there are some implications on that we need to discuss. I think as a performance type of a measurement or management type of a thing, you all need to know what is solvency test and all, and it is applicable mainly for the non-banking and non-financial type of organizations. I will just show you a particular writing on that. I will read the things. Now, just to see the solvency test, it consists of 2 parts. Now, when you say trade in solvency, we call it one is called trade in solvency or liquidity. The company is able to pay its debts as they become due in the normal course of business. Now, that is one part of it. So the other is balance sheet solvency. Now, there you have to get the value of the company's assets is greater than the value of its liabilities, including contingent liabilities. So that is what you mean by balance sheet solvency. Now, if in a company you have a company's assets greater than its liabilities, including the contingent liability, that is the issue. So if you have that type of situation, there's no issue. So the company is solvent. The balance sheet solvency is there. So, but the issue here is the term of contingent liabilities. So that's a issue where contingent liabilities can be explained in different ways, and even some companies in a fraudulent manner, sometimes they just hide the contingent liabilities. So with that, they will try to have their asset value is greater than the liabilities without taking into consideration the contingent liability. No, that is the issue. So therefore, in order to just block the companies by doing that, they just give several legal requirements to do a solvency, or we call it signing a solvency certificate. Now, normally a solvency certificate is required at certain times. So distributions by the company for the benefit of shareholder, including a dividend and incurring a debt to owe for a shareholder's benefit, solvency to apply before and after distribution. And then share purchases, share redemption options, financial assistance to acquire share is offered by the company, or in an amalgamation. At these points, the solvency test has to be done. But anyway, what I want to tell you is, it is the most important thing here is now directors need to consider all circumstances that the directors know or ought to know that affect the value of the company's assets and liabilities. In the case of contingent liabilities, consideration is required to be made on the likelihood of the contingency occurring and any claims the company may reasonably be expected to meet to reduce or extinguish the contingent liability. Now, there are contingent liabilities which should be taken into consideration when a solvency certificate is given. So these are the types of contingents where they have to report. Now, these are the contingent liabilities where they have to report under a solvency certificate. Obligations under guarantees, letters of credit, bills of exchange, current or pending litigation, performance bonds, leases, tax assessments, deferred purchase agreements, and underwriting adjustments. All are coming under contingent liabilities where they have to report under the solvency certificate. In determining, for the purposes of this particular solvency certificate, the value of a contingent liability account may be taken off the likelihood of the contingency occurring, and any claim the company is entitled to make can reasonably expect to be met to reduce or extinguish the contingent liability. Right. Anyway, I will explain these things on the board. Since the things are not visible here, anyway, I will do that. I will do it on the board. I think this is not a very difficult thing, but just to know the idea. Right. With that, we will see now the first solvency test is taken as trading solvency or liquidity. We call it company is able to pay its debts as they become due in the normal course of business. So that is very simple. Company is able to pay its debts as they become due in the normal course of business. So that's a very simple type of a thing. And I think even, when a company is doing well or company is doing normal business, then we don't need to have a solvency test, since they just do it. The second thing, it's more rigorous, and there you have balance sheet solvency. Value of the company assets is greater than the value of its liabilities. Now, but when you just say just liabilities, it won't have any issue. But when you have when you say that including contingent liabilities, then the issue comes, because you will see very substantial amount of contingent liabilities in the company. So because of that, there are several implications on assessing or evaluating the contingent liabilities. And not only that, since it is contingent, you are not in a position to say what is the real value if it really realizes. That is the issue. So I think in the solvency test or whatever, the more importance is given to the assessment of contingent liabilities, because it will really crop up the real issue. So therefore, in a solvency test, most important part is that. And the solvency tests are required in a share issue, or sometimes in an amalgamation type of a thing, or even sometimes banks ask companies to give a solvency certificate to the bank if they if they are going to extend the facility for that particular organization. So they are in such situations also, the banks may ask to give a solvency certificate. I think that particular thing is enough for you, I think, for the time being. So you have to give that, because in the Companies Act also it is mentioned, Companies Act 2007. So if you go to the Act, in the Act also it is mentioned in that manner, but as a student of corporate banking, you need to have a better knowledge, and these implications also you should understand. And anyone can just mention. It's a very easy concept, because if you know any company or whatever, assets and liabilities are there, no? So you need to have more assets than liabilities. That's what you say. But the real issue starts with the contingent liabilities. Okay.
So that certificate is usually issued by the auditors, right?
Yeah. Auditors. Even for a bank, it is yeah.
Can you share that document, sir?
I will send you.
Okay.
I will send you, because I just got it from some internet thing. But anyway, I have a Word document here. That Word document cannot be put into the screen. That is the issue. I tried my best to do it, but I was not successful. So that is the issue. Anyway, this is not a big issue. I think I just want to tell you that rather very simple concept. And not only that, if you can just go through the Companies Act also, there's a special page on this, the solvency test. They have mentioned about it. Anyway, I will send this. Anything else you need to clarify? Right. With that, I think, yes, anything?
Sir, next week's also 2:30, you are doing the lecture?
No, actually, this is my, I mean, in this particular subject area, this is my last lecture, I think. The corporate performance management. Anyway,
Okay,
now, I have you got my number, mobile number? If you want, you can have my number, and if you have any clarifications, you can just talk to me on that. Note 77298112. Note 77298112. So with that, I think if anything can be sorted out in another 2-3 minutes, you can do that. I don't know whether you have anything to clarify. Yes. With that, then I just wind up. And if you have any issue or any clarification, you can just call me and just contact me. And what I want to tell you is you need to do some type of self studies where you can have the particular presentations with you, and then even the lectures. It might be in the YouTube, and if you need to just run it again, then you can do that. So with that, you can you try to follow it, and if you come across any issues, then you can just call me. Right. Anyway, with that, I just wind up and wish you all the best in your future endeavors, and you can be successful in your examination without any type of issue. So you do your best in your examination. Thank you very much.